What's going on, everybody, and welcome back to my YouTube channel. So for today's video, I had a hard time thinking about what today's topic was going to be. I was putting out some tweets, putting out some things on Instagram, when my cousin actually DM'd me and said, "Hey cousin, I'm investing in some penny stocks. What company should I invest in?" And then it clicked on my mind, I should reveal my portfolio. Now, my response to my cousin was, I don't invest in penny stocks, so I'm not really familiar, what kind of companies are good. That's not what I invest in. I primarily focus on dividend stocks, so that's not really my field, and I want to give him bad information. But instead, I did share information about what companies I'm investing in and why, and give him that inside look. But it also made me realize that when you're just starting out and you're investing and you don't know what to do or you don't have much money, there's a few things that goes on in your mind. You want to know what companies people are investing in. You hear all the time people put money in the market, just invest, put money in, invest here, invest there. But as a beginner, you want to know specifically, what company should I invest in? How much should I put in that company? Where should I put my money? Why? Tell me these things. And those were the questions I had when I was a beginner. No one in my family taught me about investing. I didn't know any of this stuff. I didn't know what a PE ratio was. I didn't know what a dividend was. I didn't know anything about stocks. Now, I've only been doing this for about a year, so please don't take my advice. This is all hocus pocus for all I know. So please do your own research. I'm just sharing my journey with you guys. But I know as a beginner, or not even as a beginner, people just want to know what other people are doing. They want to know what other people are investing in. They want to compare. They want to see if they have the same likes and interests. They want to see if they're doing something wrong. Different points of views. And that's what I like to see other people's. I don't want to watch other people's videos because I want to take the stocks that they're choosing and just copy them. I want to understand why they're choosing companies, what their understanding of that company is, what their thought process is. Companies like Tesla and all these speculative,
What the hell did you just say?
speculative, I'm not even going to say that word, all these growth stocks. So I just want to, compare. People could get off, look at my video and say, oh, that's why that's why he's invested in that company. Oh, I never thought about that. And that's the whole reason. It's just sharing, bringing insights to the stock market and just sharing. But, here I'm going to be sharing with you guys on the screen. We got some charts to go over, look at some numbers. I'm going to reveal my whole portfolio. So in my portfolio, I own 20 different stocks, and we're going to be going over that in today's video. And before we even go into the portfolio, let me just share with you, I own 20 stocks, and the total money I have invested in the stock market at this moment is $5,496.32. That's right, I'm a millionaire. Just kidding. But again, that just goes to show you, you don't need a lot of money to invest in the stock market. Now, this money has been put into the market for over a year. This wasn't just a one-time put 5,000 in. This is, slowly adding money to the market. I just recently started adding money to the market, like weekly, monthly, whenever I get extra money, just putting it in the market. So this number will increase significantly over 2020 and the future. But I just want to show, that I'm not one of these YouTubers that have, I'm making $20,000 trades or $10,000 trades and I have a $100,000 portfolio. No, the total amount I have invested in the stock market is only $5,400. And I'm at a loss too. I'm probably down 12% across all my accounts. So, I lost about like $700 or $800, but that doesn't scare me, and it shouldn't scare you. The whole purpose is you don't need a lot of money to invest. I'm just the average person. I don't have a lot of money. I'm investing slowly, but it will get there over time. And you could do it with as little as $5, $10, $100 when you sign up for, an M1 finance account, which I will have an affiliate link down below. If you want to use that and sign up for M1 finance, with $5, you could own companies like Amazon. It won't be much, but you will own at least a little bit. And it'll encourage you, say you get a $20 tip at work, you go put the $20 into the stock market. It doesn't take a lot of money to get invested. Shouldn't scare you to get started with little money. I don't have much, and I just want to show you guys that with process, it's a slow thing. It's not overnight. My portfolio will grow. More money will be added. My net worth will grow. So it's just a process. You don't need a lot of money. Don't be discouraged. I don't have a lot of money, but enough of that. Let's get into the video. Let's go over some numbers and charts. Okay, as you can see, this is the M1 Finance portfolio. You guys are familiar with this as you guys have been following along. Just as you can see, this morning I made 6 buys. I put in $100 into the market. Did its little allocation thing. But I put in another $100 into the account. Portfolio is at 561. Has a return of negative $38 right now. That's not worrisome. Just going to keep adding. As you can see, the stock market's actually trending up. Oh, but let's get into the meat of it. So here's the first stock in my portfolio. Now, this isn't going to be the order I bought these stocks in. This is just going to be alphabetically. So the first stock on the list, Apple. So as you can see with Apple, it's part of the M1 Finance account, so it's fractional shares. As you can see here, I have 0.31268 shares at an average cost of $284.64. The next stock on my list is AbbVie. AbbVie is another one that's in the M1 Finance account, so therefore the shares are fractional, so we're at 0.72716 with an average cost of $82.49. Now, AbbVie is a company I'm actually really starting to like, and I think I'm going to add it to my individual account. That way I could get actual whole shares and really invest into this company. You know, they have great things going on in the healthcare industry. Now, AbbVie also has a PE ratio of 14. Now, the PE ratio is the price per earnings ratio. And without getting too much detailed into this, when you're looking at PE ratios, usually, you know, a good number is anything under 25 would be a good PE ratio. If you could get a high quality stock, say Apple or something like that, down into the 10s or 12s, I mean, you're just getting a steal at that price. So just understand anything under 25 is ideal for a PE ratio. If you could get it under 15, I would say you have a quality stock on your hand for a very good price. And this is what some people go and look at as far as determining if they're going to invest in a company, is waiting till they get to a certain PE ratio. For me, I don't pay attention too much to the PE ratio, but when I'm going over the numbers on the chart like this, it is nice to see that it is under that 25, but specifically under that 15 number, where I realize that I'm getting a good deal, which makes me realize that I could actually go heavier into AbbVie by putting it into my other accounts and really investing in this kind of company before it goes up. Quick interruption to the video. Sorry to interrupt like this. I know you guys were looking at some of the numbers and the portfolio of what stocks I actually had in my account. But basically, I'm going to do this for all 20 companies. If it's too time consuming, just pause the video, look at some of the things I already had highlighted from Apple, and then just look at those numbers on your own if you don't care to watch each individual breakdown and maybe some of the things I have to say about each of the companies. I don't say much about any one in particular, but if you just want to just get the overview, see what companies I'm invested in, just do that, pause, and then maybe just skip to the end if you don't want to watch it all. It doesn't have to be that, but let's just get back to the video now. Sorry for the interruption. Now, the next company is Aurora Cannabis. That's right, it's a weed company. Now, let me tell you, I don't know why I invested in this company. I just wanted to do something random. It's not even a dividend stock. This was one of my earlier purchases in 2019 when I first started out. It was super cheap. As you can see, I have 19 shares of Aurora Cannabis, average cost price of $4.24. I think I bought this thing originally when it was up at like $10. So as you can see, I averaged down heavily, and they're currently at 84 cents per share. Don't really know what I was doing with this company, but I just wanted to do something random and invest in some stock that might have some growth with the with weed going legal and all that in 2019, and it just turned out to be a real failure so far. But I'm just going to hold on. What's the worst it could do? Go to zero. I'm already at 84 cents. Might as well hold on and see what it could do in the future. Next on the list is Amazon. Again, that's in the M1 Finance account. You guys are familiar with it if you watched any of my videos. So here we have 0.01593 shares, and the average cost of those shares are $1,886.38. as you can see, Amazon has a PE ratio of 88. That is huge, but it's Amazon. They are a huge company. They are going to be big in the future. They're trading at currently $2,028.67 at the time of this recording. That company, Amazon's probably going to go to $3,000. I wish I had real capital to invest in a company like Amazon, but I don't. So hence the capital, hence the fractional shares. I'll just get my little bit while I can. Next company on the list, American Express. Okay, so I own American Express. I have 3.02 shares, and the average cost of that each of those shares is $100.41. Now, this isn't part of my M1 Finance account, but you're probably wondering, why do you have 3.02 shares of American Express if it's not in your fractional shares? How do you have that 0.2? Well, this comes from the dividend payments I have received from American Express. So I have the option to reinvest my dividends into the same company. So every time they send me a check for 36 cents, each quarter, that 36 cents goes back into American Express, and that's how we get the 0.02. Each time I reinvest my dividends, that 0.02 will keep adding up until eventually it leads to one full share, and then it's going to just keep doing the same thing over and over. And as we can see, American Express has a PE ratio of 11.47. That means it's a super steal right now, but that's just depending on how you feel about the financials. If you think whether financials are going to do good or bad right now in these horrible times. So just take all those things into consideration when you're picking your stocks, what the future is going to be. The next stock we have on our list is Chesapeake Energy. I'm going to just call it Cheapskate Energy because, one, I do not know what I was thinking when I bought this company. I think I had like $7 or like $8 left over one time. And this company was so dirt cheap that I was just like, let me buy a cheap company just because I have $8 to spend. Let me buy the cheapest company I could buy. And that was one of them. So I own 14 shares of Cheapsakes because they're cheap as hell. And I don't know what the hell I was thinking. But I have an average share cost of $3.29. They're currently trading at 16 cents a share. That's right, literally 16 cents. Honestly, this was in my beginning days. I literally just spent leftover money that I had. I had like $10 or $15. And I was like, well, let me just get a cheap company and I could spend like $5 on them and just get like 3 or 4 shares. And then they just went down a little bit and I had a little bit left. It's just something I won't do again, but it's fun to have in the portfolio to show that you can make mistakes. It's okay. Next in the portfolio is Cisco Systems. Now, Cisco Systems, I own 7.058 shares. This one is held in the Roth. The dividends are reinvested. That's how we get the fractional 0.58 portion. The average cost per share is $45.45. This is the technology, information technology sector. Now, the reason for Cisco Systems is, they make a lot of parts and things related to, things going on in 5G world. And they just make, parts for things needed in those kind of sectors. So I thought Cisco Systems was a great buy. They're down at 41.52 right now. I could probably be averaging down on those because I believe this stock is going to be going up in the future. They got a good PE ratio going right now at 16.21. Still good. It's not too high. It's, not the lowest it could be, but it's right around that 15 number. I mean, 15 is probably that ideal number, and it's right there. Next we got is Disney. Now Disney, I own 2.84 shares. Now Disney was the first stock I ever bought, and it's in both my everyday individual account and the M1 Finance. So you guys see a little bit of the M1 Finance, but it's right there at 2.84082 shares at $112.84. Disney's down at $101 a share right now. It's one of my favorites. I know Disney. Everyone knows Disney, Disneyland, Disney movies, Pixar, all those things. I think it's going to be here for the future. I'm not sure why they took a big hit, especially with everyone being at home. I mean, I've seen this stock as high as 150. I think it was like 148 was the 52-week high. So this stock has potential to grow, and they pay a dividend. It's not the best yielding dividend. You don't get much for your money within Disney, but it's a company that's going to be around for years and years and years to come, perhaps even generations. And they have a PE ratio of 16.18, which is good. The next one on the list is Hawaiian Holdings. They're Hawaiian Airlines, basically. And so for Hawaiian Airlines, I own 3.028 shares at the average price of $34.23. I bought this one in the beginning. So I'm actually part of a group called the Motley Fool, where I paid basically $200 for I think I paid somewhere around like $200 for a 2-year subscription to Motley Fool. And, these are supposed to be some of the best, and not the best investors, but these guys just have a long track record. You could look them out. You could look them up on Google. They have a whole blog and the whole thing going called the Motley Fool. Now, what the whole subscription is they send out their top 5 best buys of the week. So every Thursday they send out like, hey, the top 5 stocks that are on our list, the top 5 stocks. And some of these companies have came from the Motley Fool that I've actually invested in that we haven't went over yet, but actually, this is the first one, but Hawaiian Holdings was on there. It wasn't on their top 5, but I did find it through the research on their blog site, and I just went with the Hawaiian Holdings. I don't know why, when there's so many better airlines out there, but you know what? This one was the cheapest one at the time when I was investing, and I didn't have a lot of money, and I just wanted to, diversify the account, and I went with Hawaiian Holdings. Now, they have a PE ratio of 2.38. I don't know if they're going to suspend their dividend. Basically, that's a super low PE ratio, kind of unheard of. So they're probably going to be suspending dividend. There's no way they could manage the business and have a PE ratio that low and pay their investors. And we're halfway down the list with Home Depot. Home Depot is another one in my Roth IRA. I'm a big fan of Home Depot. I think, for the home builders, for the real estate, I think it's just a great company to be a part of. People are always going to need to buy supplies from Home Depot, or they have large stuff with their supply chains in China and stuff. So that's why they've been taking a hit lately. But besides that, real estate isn't going nowhere. Houses aren't going anywhere. Building supplies aren't going anywhere. And that's why I invested into Home Depot. Now I own 2.042 shares. Again, that's because of the reinvestments go into the stock, for an average share price of $221.78. Currently, they're trading down at $195. I should probably be averaging down and picking up some more, but I haven't done it yet. Now, they have a PE ratio of 19.11, a little on the higher side. If the scale was 15 to 25, they're right in the middle. 25 would be like, I maybe should not invest in this company until it gets a little bit lower. 19 is still in that, okay, I could, willingly invest into this company. No problem, but a little bit on the higher side of the PE ratio. The next one on the list is Health Equity. They are in the healthcare sector. Now, I have 3 shares at $67.34 as the average price. Right now, they're currently down at $51.55. Now, this is one of the stocks I picked up from the Motley Fool. And even though this stock is currently down, I've seen this company give me returns of, up to 30 or 40%. This company does have growth available, but right now it's just down with the whole coronavirus thing. But besides that, this is a growth stock. So you see higher fluctuations, up and down. So I've seen this stock really high and I've seen the stock go really low, but it's in the healthcare sector. I feel like it's going to be around Now it says they have a PE ratio of 88.87. I'm not sure if that's very accurate. I would have to redo some calculations. This is not my spreadsheet. I downloaded this spreadsheet. It already had the formulas included. I just went and punched in, my ticker symbols and how much quantity I have and my average share price and all those things, and it formulated the rest of the spreadsheet. So again, I'm saying information like PE ratios at 88 or 19 or 14, but that information may not be correct. So that's why you need to go out and verify. I'm not trying to put out information that's false or misleading, but this is the information I'm reading, and I haven't actually calculated to verify any of this. But most of these numbers are very accurate, but this PE ratio just seems a little odd to me. Next is Johnson & Johnson. I really want to get more into Johnson & Johnson. They're a household name. You go in your house, you look on some of your products that you use, you're going to see the name Johnson & Johnson. So this is in the M1 Finance account, 0.5947 shares. Average cost at $141.87. They're currently at $140 a share. Johnson & Johnson has got down recently to $114. I should have probably loaded up heavy when it was down there. I missed the opportunity. It's all the way back up to $140. Sucks for me. If you got in on Johnson & Johnson, congratulations for you. This company will be around forever. They're currently trading at a PE ratio of 24.87. They are a premium stock, hence why it's closer to that 25 mark. They are at premium. I probably wouldn't load up now with it being back to where I've started my position with Johnson & Johnson. But again, they got down to 114. I should have invested in them. They probably had a lower PE ratio then, and it probably would have been a great time to buy. Right now, they're trading at a premium. Take that into consideration before I'm not saying don't invest in Johnson & Johnson. They're still a good buy, but I just wouldn't load up heavy as they're trading at, their normal prices. Another one of my favorite companies, 3M. So I own 7.039 shares at the average price of $154.07. 3M is currently up to $146. In the recent weeks, 3M has been down to a low of $125. I probably should have loaded up on 3M. They're well diversified. I mean, they make everything from masks to sticky tape to sticky notes to the tape you put on your walls. I mean, duct tape. They're just heavily invested in all these different things. They have a wide range of products. 3M is going to be around for a very long time, and they're a company I feel very comfortable investing in, and I want to invest more. They have a PE ratio of 1874, and if you see numbers changing on the screen, it's because this is actually live and pulling actual data and scraping from websites and actually updating information. So that's why you see some of the numbers changing, because this is actually happening live. But again, they're trading at a PE ratio of 1874. Still a good buy at this time. Another company I have is Okta. Now, many of you have probably never even heard of Okta, but the reason I'm familiar with them is for two reasons. One, my old employer used to use them as part of their sign-in thing. So it was powered by Okta. So they're heavily in the information technology sector. They're basically software. And I own 3 shares. My average price is $81, and they're currently at $128. Let me just say, Okta has treated me very well, both before this crisis and after. This has been one of the best performing stocks that I've had through my entire time of holding a stock. Like, I haven't seen this stock go below 81 when I bought it. I've only seen it go higher and higher and higher, and just a little bit lower and then higher. So right now I have like a 58% gain on Okta, and I've seen it higher than that, and I've seen it get as low as the 30%, but I can't remember a time that this thing went below 81 when I actually purchased. And I seen it on the Motley Fool. It was actually one of their suggested buys. I bought 3 shares of them because I said, oh, my company actually uses this company Okta to power their services, their login services, remote logins, all those kind of things. I was like, this company is going to be around. I wish I loaded up on more than 3. That's just a missed opportunity by myself, but that just goes to show, that just putting your money where you're familiar with companies could yield a great return. I was familiar with Okta. Many people don't even know about Okta or what they do, and therefore they missed out on a great opportunity, and they're probably buying now when they could have bought way before. And I'm just glad I got my little 3 shares in at the $81, but I should definitely be adding to that position. Next is PPL Corp. And I'm gonna be super honest with this one. I really don't know what PPL Corp does. And you ask yourself, well, why do you own 15 shares? And if you don't even know what this company does and who they are, well, I'm part of a Facebook dividend investing group, and people talk about PPL Corp a lot. People are really interested in this company. They're in the utility sector, and I just went with the research based on those people. I see a lot of people talking about it. I see a lot of research that they do. Maybe doing this video, I should go out and do my due diligence into this company now and either load up more or not. But sometimes it happens. Sometimes you get influenced by other people. You allow other people's decisions to be yours, and I'm okay with that. For this company, it's something that I've seen them talk about a lot, and I was just comfortable making this purchase of PPL Corp, and that's what it is. They're trading at a PE ratio of 10.56, which means I could even load up heavier on this company if I wanted to. They're trading at a great buy right now. If you've seen just a few seconds ago, my average cost was at $32. They're currently trading at $25, so I could definitely average down. They pay a dividend. What more do you need to invest in a company with a PE ratio of 10, with growth on their side? It's just a company to look into. Next one on the list is Square. I own 4 shares of Square, average cost of $70.29. Right now it's currently trading at $55.84. Square, everyone's familiar with Square, handheld mobile device. You could plug it into your phone and collect payments from anyone. You could run a business from a sidewalk and collect payments. This was actually started by a kid in San Francisco many years ago. So definitely got support for, a San Francisco kid starting up this company. I'm not saying he's from San Francisco, but the company was started in San Francisco where the kid was living at the time. And, got nothing but support. I've seen this company treat me well. Right now it's down, but I've seen this company very positive. And I just think people are going to use this Square device and being able to be entrepreneurial, having garage sales, taking Square devices. Matter of fact, I heard a story about when this kid started up Square from a lady who came down to the business, and she was like, "Oh, you guys use Square?" I'm like, "Yep, pretty common here nowadays." And she was like, "Oh, that kid actually used to be my neighbor, and the reason how we got introduced to Square is we're having a garage sale, and this kid comes up and goes, 'Hey, do you guys take credit cards?'" And she looked at the kid like, "Are you crazy?" Because this is back in 2006, 2007. I'm not sure when Square started, but it was around that time, and they were having the garage sale. She was like, "Are you crazy? Like, this is a garage sale. Like, where would I take a credit card? Like, cash only?" And he's like, "Well, let me introduce you to my device called Square." And he signed her up for an account. It's his neighbor. He signed her up for an account, created her a Square thing. And how what a pitch that this kid would probably went around to garage sales. Like, are you potentially missing out on some money? Maybe not everyone has the cash. Maybe they want to spend a little bit more than the cash they brought. And to pitch them like, "Hey, do you take credit cards?" And for them to say no, and then you have this device that they can now collect payments. Just genius. And of course, that's why the PE ratio is up at 69.38. Very high. Very high. I still believe in Square though. So, I wouldn't load up super heavy into Square, honestly, as there's probably going to be new technology probably leaving Square. There's probably going to be what is Square going to do when the dollar goes to zero, or when there's no longer credit cards being used and everything goes to crypto. So there's always that factor into it. But for now, Square's in my portfolio. Now, one of my most recent purchases into my portfolio is T, aka AT&T. Now, I wanted to get some exposure into the 5G, as that's where this world seems to be going. AT&T is part of that. Again, Cisco builds some of those parts for the 5G networks and the devices needed. You see how it goes hand in hand there. So I have 19 shares with the average price of $29.96. They're currently trading at $29.44. They have a PE ratio of $15.52. They're right there at the 15 mark. Perfect. With the 19 shares, the dividend, today's like the last day of their dividend. I think they pay out on May 2nd. So with their dividend, I added an extra 3 shares alone today. I had 16 shares last week, added additional 3 shares because I believe today is the last day to basically buy shares to get your dividend payment on May 2nd. So on May 2nd, I'm probably going to get about $9.88 from owning AT&T. I'll probably get around $40 a year if I just held this position, but I'll probably be heavily loading into this company in the near future. Definitely want to diversify and get some exposure to that 5G. Next company on the list is Twilio. This is another one that was picked up from the Motley Fool, and this is another one that has treated me well, although recently it has been going down. So I own 4 shares of Twilio at $120.52 as the average share price. Well, right now they're trading at $90.51. Now I've seen this thing go very positive for me. I've seen it go super negative. I've seen it go all the way back up to 120. I've seen this position before Corona happened. This stock was below. I could have averaged down. I seen it go all the way back up to 120. I knew it was going to do that. And then now I seen it go all the way back down. This is another one of those growth companies. That's why they have those large swings, a lot of day traders going on. But this is a company that I know could go over the 120 mark. I've seen it be done plenty of times. I've seen it jump from the lows all the way back to the 120 average that I'm at to higher, then back all the way down to low. I should be averaging down on this company for sure. Then we got VOO. It's just a Vanguard S&P 500 ETF. That's in the M1 Finance portfolio. I own 0.71454 shares at the average price of $274.34. It's always good to just hold some index funds or some ETFs, just to have those in the portfolio where they just go and invest in all these companies, and you get a wide range of companies in one portfolio or ETF, and it's just easy to follow. There's no reason for not to have one of these in the portfolio. It's just let me invest and forget about it type of fund. And the last of my 20 stocks is ExxonMobil. Now I own 1.04301 shares at the average price of $50, currently trading at $42.35. They do have a PE ratio of 13.25, so they're a great buy right now. Look, whether you think clean energy or renewable energy is coming, oil is still going to be used for many things. I have no doubt that ExxonMobil is going to be able to adapt to the changing times. They're a great buy. They pay a dividend. You could go ahead. I think at the current prices, if you went and spent about $4,000 on ExxonMobil, you would actually understand the power of compounding interest. With $4,000 invested into ExxonMobil right now, every quarter when they pay out their dividend, you would basically be able to, with reinvested dividends, you would be able to buy one new share every 3 months, compound that yearly over decades. I mean, the power of compounding in this situation would be a miracle if you had $4,000 to invest in ExxonMobil. Now, I'm not saying that should be the only company you invest in. So if you had like $4,000 and ExxonMobil is going to be the only company you invested in, that might be a nightmare, because when something bad happens in the economy and now you lose 100% of your portfolio because you're not diversified, that's scary. That's troubling. But they are trading at a very good PE ratio right now. Still a buy. I want to add heavily to this position. The whole reason I even downloaded the spreadsheet was not to get the list of the companies I own or all of that, but it was actually to get this sector breakdown, because I wanted to figure out how much I was invested into each sector, and then that way I know what I should be investing in. So what I just pulled up here is a screenshot from Seeking Alpha. Now this little thing is, what an ideal sector allocation would be for someone, in kind of companies. That way it's safe, you're diversified, you're not overly weighted. So let's just compare some of these. So consumer staples. Now I have consumer cyclicals. Consumer staples is there. 12.5% for healthcare, and healthcare I'm only at 1.7%, so I should probably be adding a lot more to the healthcare industry, the healthcare sector. I should go research more companies or load up on my positions, because clearly I'm underweighted here in my own portfolio. Industrials, 12%. I'm actually double that in my portfolio. I'm okay with that being doubled in my portfolio. I am going to be adding to other positions, but I'm very comfortable with the positions and the companies. It's not like I'm invested into 30 companies that make up this 24%. I'm invested in some great long-term companies that I'm very comfortable with that being 24% of the portfolio right now. 12% for financials. My financials is at 6%, so I should probably double that. Should probably get some Visa. Visa is one of those companies that are like top tier of the financials. I really want to get into Visa. I should do it. I should keep adding into American Express, things of that nature. We got energy and materials at 10% according to Seeking Alpha. My energy is at 1%. I definitely need to get more into the energy department, more ExxonMobil, maybe some BP. I just need to add to the energy sector because I'm not very diversified in that sector. Information technology at 8%. Information technology, I'm almost tripled that, what I'm supposed to have. Again, I'm okay with that. My positions, I'm very comfortable with owning all the companies I do own, and I'm okay with mine being at 22%. REITs, 7%. I actually own zero real estate REITs, so that should be something I'm looking at in the future. One of the companies I'm very closely looking at is a company called O Realty Corp. Realty income. So if you're looking for a real estate REIT, I would consider O. 5% in telecommunications. Now I am heavily weighted in communication services at 24%. They're suggesting only 5%. But again, I'm okay with my positions. Utilities, 2.5%. I'm at 8.9%. So, a little overweighted there according to their measures. But again, this is just an idea. This doesn't have to be what your portfolio set out to be, but it's just something to look at. But let's go back down here. Just with this, I just want to share with you again, I got about $5,500 into the stock market, and right now we're down 12% across my portfolio at $619 loss, but my yearly annual dividend income, excuse me, I just sneezed. I wonder if I should keep that in the video or not. So my annual dividend income as of right now, so it's $152 that it'll be this year, 2020. Let me show you what 2019 looked like. 36 cents in February, $1.53 in May, $3.29 in July, $1.65, $1.65, $2.88. In 2019, I only received $11.28 in dividend income. Whereas in 2020, I've already almost did that in the first 3 months. And the expected dividend income is, ooh, bless me, I swear I don't have coronavirus, I promise you guys. But my annual dividend income is expected to be $152.49. I can't wait to get that number to $500 a month. I mean $500 a year, then $1,000 a year, then $10,000 a year, and then hopefully $12,000 a year. But hopefully that $12,000 a year is broke down to roughly $1,000 a month. I wish I could have $1,000 a month in dividend income. Probably at that point I'll start collecting that dividend income and stop reinvesting it, and just be able to collect $1,000 in dividends every single year. That's $12,000 a year just for investing in the market to pay me for being invested in them. Now, I wanted to come over to Yahoo Finance, where I also have my portfolio inputted here. And according to my risk profile, it's moderately aggressive, kind of on the lower side of the risk spectrum. Me being 24, I kind of want to push that risk level to the higher side. I'm not scared to lose money, but I also do want to make money. So I'm going to figure out how to get that risk level a little bit higher and be able to diversify at the same time, but add some risk into my portfolio. You know, scared money don't make money, and you shouldn't be putting money in the market that you need anyway. So whenever I put money in the market, I'm not expecting that money back. But hey, that's my portfolio. That's my 20 stocks. That's my $5,500 that I have invested in the market. It's nothing crazy. This is just the beginning of my journey. This is definitely nowhere near the end. Like I said, eventually I want to get $1,000 a month in dividends. I'm far away, but it's a process. This is nowhere near closely going to happen overnight. I'm not going to become a millionaire overnight, but it's a slow perk, and I'm willing to fight and grind for it and receive some, passive income. This is probably the only passive income you receive. You put money in the market, you don't think about it, they pay you back some money. But what I will have down in the description box for future videos, I'm going to have the M1 Finance. I'm going to share my pie. You guys might not want to invest in the pie, but at least you guys could see an update on the portfolio, the count, when it's doing bad, when it's doing good. You guys could just click on that, see the updates, see how the portfolio is doing as an overall view. I appreciate you guys tuning in. If you stayed the whole time and really listened to what I had to say, sharing some of my experiences with the companies, why I picked them, where I got the information from. I even discussed that I didn't know about a specific company at all, but I just invested because some of the people in the Facebook, a lot of people in the Facebook investing group were doing it. But again, I appreciate your time. I appreciate you tuning in. If you guys don't follow me on Twitter or Instagram, my @ is For the Uninformed. I'll have that linked in the description box. That way you'll be able to see up-to-date stuff, like when I'm making a buy, at what price, and you get more of that up-to-date information versus waiting a week to get things out. If you enjoyed this video and you learned something, please give it a like, subscribe to the channel so you can see more videos in the future. Go ahead and share this video with a family member or friend, someone who's just starting out in investing and don't know where to go or what kind of companies to invest in. Give this to them for some ideas. DM me, ask me questions. Don't be afraid to reach out. That's what we're here for, to learn, to share information, and create wealth. No one wants to live day to day, paycheck to paycheck. We're on here to create a better life. We all deserve a better life, but we got to take that first step and start putting money in the market, start putting money into real estate, start putting money into ourselves, start creating businesses. I don't know how this turned into like a positive motivational thing at the end of a YouTube video, but let's just end it there then.